Hi guys, welcome to Neha Edufi. Dear friends, new union budget is declared and lot of discussion is going on about long-term capital gain tax that was implemented on equity as well as mutual fund investments in this budget. Long-term capital gain tax on the sale of equity and equity funds has now been introduced. Finance Minister Arun Jaitley said long-term capital gain from sale of equity shares and equity mutual fund schemes will now be taxed at 10% if your total capital gains in a year cross rupees 1 lakh. Below rupees 1 lakh, gains won't be taxed. This is not the case that this tax is being imposed first time. It was there before 2004. In 2004, the government abolished long-term capital gain tax on equities held over a year and introduced the securities transaction tax in its place. But now, according to new recommendations in budget, long-term capital gain tax has been brought back in and the securities transaction tax still remains. And this started the whole discussion. People are asking how it will affect the investors. Now what steps are to be taken? Whether changing the scheme of mutual fund or changing the option may help. Are there any escape ways to save this tax? Whether this long-term capital gain tax is beneficial for mutual fund schemes or it will be a disaster. One and many questions are coming in the mind of mutual fund or equity investors. We'll try to find out, we'll try to analyze the things in this video. Friends, as of now, any redemption from mutual funds or sell off from the stock market in less than 12 months attracts 15% tax. This is short-term capital gain tax on all equity mutual funds, including balance fund, arbitrage funds, and even equity-linked saving schemes too. For debt mutual funds, we are paying short-term capital gain tax according to your tax law. Fixed deposits, salaries, and most other income and other savings are taxed up to 30% based on the earnings bracket. But any income from holding shares or mutual fund units beyond 1 year has remained untaxed. And now government has imposed tax on this scheme. Such income, that is your gain, above rupees 1 lakh, will now be taxed at 10%. But remember, this is still lower than the short-term capital gain tax and 1/3 of what you would pay if your earnings are in the highest tax bracket from any or all other sources like fixed deposit and most other income and saving. So this is not too bad at all like it was first pursued. Why I am saying like this? Because this is not retrospective taxation. We have to understand this term or the term that is being used in budget, that is grandfathering. Understand that a long-term capital gain tax at 10% will be imposed on gains exceeding rupees 1 lakh without allowing the benefit of any indexation. However, all gains up to 31st January 2018 will be grandfathered. Now what do we mean by this? Grandfathering of all gains up to 31st January 2018. We will have to check out with this an example. Let's see. We'll check out this grandfathering term with one example. So dear friends, for understanding this term of grandfathering, we have to check out one example. But before that example, we'll just analyze what was the situation of short-term capital gain tax and long-term capital gain tax before this before this tax regime. Before, if you consider this short-term capital gain tax and long-term capital gain tax, for selling of equity or mutual fund units before 1 year, short-term capital gain tax was charged at 15%, whereas this long-term capital gain tax was 0%. Whereas now in this new tax regime, the short-term capital gain tax was kept as it is 15%, whereas this new 10% long-term capital gain tax is being implemented. But how calculations will be done for this long-term capital gain tax, that we have to check out. Now consider over here, if on 18th February 2017 you invested 100 rupees in mutual fund and the value of this investment turned out to be 140 rupees on 31st January 2018. And if you sell this investment in coming days, let's say 30th July 2018, and you got rupees 180. Then over here, your total long-term capital gain will be this 180 minus 100, that is 180 minus 100 equals to 80. This is what your long-term capital gain. But according to the provision in union budget, whatever they have said, that whatever your gains and whatever your investment till 31st January 2018 will be grandfathered. Meaning is that whatever you have gained till 31st January 2018 will not come under this long-term capital gain. The long-term capital gain will be calculated like this. This 180 minus gain till 31st January 2080 equals to 40, and this will be considered as your long-term capital gain, and then it will be considered for taxation, and that too if your long-term capital gain is more than rupees 1 lakh in one financial year. So this is the term of grandfathering. So friends, in this way grandfathering is allowed, and this long-term capital gain taxation is not retrospective taxation. By the way, if the price of your mutual fund investment on 31st January 2018 is lower than your purchase price, then your purchase price will be considered for the purpose of calculating the long-term capital gains and the resulting tax. The taxation of capital gains for debt mutual funds remains unchanged. That is, short-term capital gain tax for holding less than 3 years will be according to your current income tax slab, whereas long-term capital gain tax is 20% after indexation for holding above 3 years. In this way, long-term capital gain tax will be imposed, and most importantly, do note that the tax is applicable if such long-term capital gain exceeds rupees 1 lakh in the financial year, and even that is subject to realization. Of course, some statistics may be there when this long-term capital gain tax was penciled. But what statistics a common investor have to follow? What statistics a common investor have to adopt? That is the most important question. As far as me is concerned, this long-term capital gain tax is not as bad at first glance because of provision of grandfathering of older gains, which allows the cost of holding to be taken as the market value on 31st January 2018. In this scenario, what should investor do? There is no need to worry and no gains in running behind to redeem your mutual fund investments now. It will not be much helpful, or it will not increase your gains. Taxes need to be paid on any appreciation after 31st January 2018. You may adjust your investment or gains in this financial year so that your long-term capital gain on sale of units does not exceed rupees 1 lakh. You can reinvest the amount later. That's it. Rushing to redeem your existing mutual fund investment will not be beneficial. So stay happily invested. Even you can consult to your financial advisor about developing a strategy of booking profits at regular intervals by keeping long-term capital gains less than 1 lakh in a year and reinvesting it later. You can read more about this in links given in description. And of course, I am not a tax expert, and you can take advice of a chartered accountant, or for better understanding, or for before taking any decisions related to your investment, it is always suggested to take advice of a chartered accountant. And one more disclaimer: mutual fund investments are subject to market risk. Please read all of the documents carefully before investing. Thank you. Stay tuned. And if you are not subscribed to this channel, then please do subscribe. Stay healthy and stay wealthy. Thank you.